Sometime this week, maybe as soon as tomorrow, PayPal's board decides whether $53 billion from Stripe is a gift or an insult, and Michael Burry's already told them which one he thinks it is. Good morning, it's Sunday, July 19th. I'm Nick Fertucci with Eleanor Whitfield and Marcus Brooks. This is the week ahead, our Sunday setup show. No grading today, that was yesterday. Today we're looking forward.
Morning, Nick.
Morning, and it's a loaded one.
It is, which is why we've pulled Dave Sullivan into the fourth chair. Wednesday alone has more single stock earnings risk than some entire quarters. Dave, welcome back.
Good to be here. Wish it were a quieter week to break the seal on, but I'll take it.
Quick housekeeping before we get into it. Season standings, so you know where everyone's coming from. Eleanor's 4-4, streak of -1. Marcus is 3-7, streak of -3. Dave, you and Sarah are both 0-1, sitting on ice since Sarah's Brent call a couple weeks back.
Lovely. I get to start the week already losing.
Welcome to the club.
You'll get a call of your own before we're done today, so you can start digging out immediately. Let's build the show. 5 things this week: PayPal's board decision, Wednesday's earnings pileup, whether the chip bear market gets worse or reverses, the oil standoff, and what actually breaks the stalemate, and the Fed backdrop heading into the following week's meeting. Dave, you're leading us into PayPal since you've been closer to the fintech side of this than any of us.
Happy to. Quick recap for anyone who missed Tuesday. Stripe and Advent International offered $60.50 a share, $53 billion total, 28% premium to where the stock closed the day before. $50 billion of that is already committed bank financing, so this isn't a paper offer, it's a real one.
And the board hasn't said yes.
Correct, and by Friday's reporting, they were leaning towards saying no. Sources describing the offer as inadequate, not just under negotiation. The board's expected to meet as early as tomorrow, Monday, to formalize a response.
Which is the interesting tension, because the stock's trading well below both numbers that matter here, below the 60/50 offer, and way below what Michael Burry says it's actually worth.
Burry's fund holds PayPal as one of its largest positions, and he came out and called $60.50 simply too low. His own range starts at 75 on the low end and runs up into the 110-115 area on the high end.
A stock trading at 9 times earnings before any of this broke. That's the setup that makes we're worth double a credible argument instead of a hedge fund guy talking his book.
So, if the board says no tomorrow, what actually happens next? Walk me through the realistic paths.
3, roughly. 1. Stripe and Advent come back with a higher number, which is the most common outcome when a board calls an offer inadequate instead of rejecting the whole idea of a sale. 2. The board rejects it outright and PayPal stays public, in which case you'd expect the stock to give back a good chunk of this month's pop. 3. Somebody else shows up, a $53 billion target that a strategic buyer and a PE shop both wanted enough to pre-arrange $50 billion in financing, tends to attract a second look from other bidders.
I put real weight on path 3. Honestly, more than people are pricing. Once a board publicly signals a number's too low, it's effectively put the company up for sale in everyone else's eyes too, whether that was the intent or not.
Which is exactly why I don't think no tomorrow means the stock craters back to where it started. A credible rejection with a credible fair value range sitting out there from a serious investor is a floor, not a cliff.
Give you the number that tells us this is moving in Stripe's favor versus stalling.
Watch for any amended filing or lead term sheet with a strike price above 65. Below that, and I think this drags for weeks. Above it, this closes by fall.
What about the regulatory piece? Stripe buying a direct competitor isn't exactly a clean antitrust story.
It's the other reason the board can afford to say no tomorrow without spooking the stock too badly. Stripe and PayPal both sit on a huge share of online checkout between them. A deal like this likely draws a real second look, and that review alone could run into next year. Inadequate price and long regulatory runway are 2 separate reasons to hold out, and right now PayPal's board has both.
Which actually cuts against Marcus's floor argument a little. A deal that drags through review for a year is worth less in present value terms than the headline number suggests, even if the price eventually gets bumped.
Sure, but that's a discount rate argument, not a this deal is dead argument. I'd still rather own the equity of a company with a serious buyer circling and a Burry valuation floor under it than one with neither.
Good. That's a real marker. Thank you. Let's move to the day that's going to swallow the rest of the week whole. Wednesday, July 22nd, when Alphabet, Tesla, Intel, and Texas Instruments all report, some of them within hours of each other.
4 earnings reports that between them probably decide whether last week's chip bear market was the top of the AI trade or just a scare in the middle of it.
Start with Alphabet, since it's the one everyone's actually going to be watching live.
Alphabet reports after the close Wednesday. Consensus is looking for GAAP earnings between $286 and $295 a share, revenue in the $117 to $120 billion range. But the number nobody actually cares about is Google Cloud growth and the CapEx line.
Cloud grew 63% year over year last quarter, $20 billion, the fastest of any major cloud provider, and the backlog nearly doubled sequentially to $462 billion. That's the bull case for the entire AI trade in one metric.
And they already raised full-year CapEx guidance to $180 to $190 billion last quarter, with 2027 guided to go higher still. So the real question Wednesday isn't whether they spend more, they've told you they will. It's whether the stock can absorb hearing it a second time the way TSMC stock couldn't 2 weeks ago.
Right, and that's my worry walking in. We just watched a company post a genuinely historic quarter and get punished because the spending bill attached to it scared people more than the beat reassured them. There's no reason Alphabet's immune to that same reaction Wednesday night.
I'd argue Alphabet's actually better positioned than TSMC was, because the backlog number is the antidote. $462 billion in signed contracted cloud revenue isn't a promise. It's paper in hand. TSMC was asking you to trust that the CapEx converts. Alphabet's showing you the order book that already proves it.
Showing you an order book from 12 months of a boom is not the same as showing you it holds up 3 years into elevated depreciation. I'm not saying the backlog isn't real. I'm saying real today and durable through 28 are still 2 different claims. Same argument as 2 weeks ago.
You two didn't settle this with TSMC, and it sounds like you're not going to settle it with Alphabet either.
No, and I don't think we should pretend to.
Then let's leave it there and let Wednesday do some of the arguing for us. Intel and Texas Instruments report the same day. Dave, quick hits on both.
Intel's expected to post 22 cents a share against a loss of 10 cents a year ago. Revenue around $14.4 billion, up roughly 12%, a real turnaround quarter on paper. Texas Instruments, Street's at $192 a share on $5.24 billion in revenue, and options pricing has about an 80% chance they clear $4 billion in analog revenue, which would be their 4th beat in 5 quarters there.
TI is actually the one I'd watch closest for a read on the real economy side of chips, not just the AI side. Industrial revenue was up 30% last quarter, data center up 90%. That's not one hyperscaler's CapEx budget, that's broad demand.
Give me the scale of the drawdown one more time, because I don't think the number's fully sunk in for anyone who tuned out midweek.
The SOX had soared 105% off its March low into last month's peak, genuinely one of the great runs in the index's history. From that peak, it's now down more than 20%, officially a bear market as of Friday. Marvell, ARM, and Intel are each down more than 30% over that same stretch. This isn't a broad market wobble, it's a sector that went nearly vertical and then gave back a fifth of its value in a few weeks.
Which is also just what a 105% rally looks like when it corrects. I'd be more worried if a move that size hadn't given anything back at all.
And hanging over literally all 4 of these reports is the thing that broke the SOX into a bear market in the first place.
Kimi-Cree, the Chinese model Moonshot, put out 2.8 trillion parameters, open weight, and the company's claiming it rivals the Frontier systems out of the US. It's the same shock DeepSeek delivered last year. If a cheaper open model can do most of what the trillion-dollar build-out is supposed to justify, the CapEx wall gets a lot harder to defend.
I said this Saturday and I'll say it again. A claim from a startup's own press release isn't the same as an independently benchmarked result. Every one of these Chinese model launches gets priced first and verified second. That doesn't mean it's wrong. It means the market's reaction on Friday was bigger than the actual evidence so far.
I'll split the difference. I've looked at some of the early third-party benchmarks trickling out this weekend, and it's not nothing. It's genuinely competitive on a couple of reasoning tasks. that's not matches GPT-5 class systems across the board, which is the stronger claim getting repeated in headlines.
So Wednesday isn't just an earnings day, it's the market's chance to actually answer the Kimmy question with real numbers instead of a press release.
That's exactly right. If Alphabet's cloud backlog keeps growing and the guide holds, that's the market voting the spending still justified regardless of what a Chinese lab claims. If it doesn't, Kimi becomes the story of the summer instead of a one-week scare.
And it's not just those four: IBM, ServiceNow, and Raymond James Financial all report this week too. So we'll actually get a software and financial services read alongside the chip story, not just a hyperscaler one.
Which matters because if IBM and ServiceNow show enterprise software spending holding up fine while the chip names wobble, that argues this is a hardware and CapEx story specifically, not a broad AI spending pullback.
Devil's advocate for a second, because I want to press both of you. Marcus, if Wednesday goes badly across all four names, does the healthy repricing, not a bubble argument survive, or do you have to actually revise it?
I'd have to revise it. I said Saturday my tell was Nvidia trading down on genuinely good supplier news for more than a couple weeks running. 4 bad reactions in one day, on top of last week, starts to look exactly like that. I'm not hiding from that test.
I'll give him credit for setting it that specifically. Most people don't put a number on when they'd change their mind.
Let's move to oil, because Wednesday's earnings avalanche isn't happening in a vacuum. It's happening against a backdrop where yields are already higher on a war, not on the Fed.
WT, I closed the week at 81.14, Brent at 85.95, 5 cents for my call, which I'm still not over. The blockade's been in effect since Tuesday. 20% toll on cargo transiting without American authorization, and tanker traffic through the strait has collapsed from the high teens or low 20s a day down into single digits by Thursday and Friday.
And yet 6 sanctioned supertankers, 12 million barrels combined, slipped through dark-hulled transponders off in the same week, according to Bloomberg. Oil's finding a way through. Quietly, but it's moving, and that's why Brent's in the mid-80s instead of the triple digits a full closure would produce.
I said Saturday that 6 tankers going dark is evasion, not commerce, and I stand by that. At that volume, most of the fleet isn't finding a workaround, it's sitting still or routing around Africa, which adds weeks, not days, to delivery. That's a supply story building, not one that's already priced.
You two left this exact disagreement open on Saturday's show. Where does it stand walking into the new week?
Exactly where it was. If the tanker count stays in single digits through Friday, I think we're testing $90 before the week is out. That's not a hedge, that's my actual view.
And I think if shippers keep adapting, insurers pricing the toll into freight rates, routes settling into the new normal, the count climbs back toward the teens by midweek, and Brent holds the mid-80s rather than breaking higher. Same test as Saturday, watch the vessel count, not just the headline print.
Then that's the number I want every listener to actually watch this week, not just us. Daily transit counts through the strait. If they're single digits Friday, Eleanor's right. If they're back near the teens, Marcus is right. I'm not picking a side, because I don't think either of you has actually earned me picking one yet.
Fair.
Fair.
What does this actually cost a shipper, in plain terms? The toll, the risk, all of it.
Say a tanker's carrying 2 million barrels. A 20% toll on a cargo worth roughly $170 million at current prices is on the order of $30+ million before you even price in war risk insurance, which underwriters have reportedly been marking up sharply given 9 attacks on shipping since July 6th. That's the cost Marcus says gets passed through to buyers.
And it does, that's exactly my point. A shipper who can do that math and still make the transit worthwhile is choosing to sail. The ones who can't are the ones rerouting or sitting still. That's a market clearing at a new price, not a market that stopped functioning.
Or it's a market where only the biggest, most sanctions-tolerant players can still afford to move at all, which is a very different kind of clearing.
One more piece on the commodity side, because it explains why gold's behaving so strangely through all of this.
Gold sliding toward $4,000 an ounce, even with a live Middle East war on, which is backwards from the textbook. Higher oil is pushing a stickier inflation read, which pushes real yields up, and higher real yields are a headwind for an asset that pays no yield at all. It's trading like a stagflation hedge would trade, not like a safe haven.
Worth noting, Bitcoin's telling a related story. It slipped from around 64.7 Thursday to 63.8 Friday, moving with risk assets generally instead of acting like digital gold. If crypto were actually functioning as the safe haven bulls claim, you'd expect it decoupling from equities into a shock like this, not tracking them down.
Let's pull the lens back to the Fed because there's a meetings the week after this one, and this week is really the runway into it.
July 28th and 29th, Kevin Warsh's second real test in the chair. His first two appearances, House Tuesday, Senate Wednesday, the week before last, were deliberately boring, and it worked. Nobody's talking about anything he actually said.
Which was smart for a chair walking into a committee where something like half the room's already on record wanting another hike.
So what changes between now and the 29th that would actually move him?
The thing I'd watch is whether oil-driven inflation shows up in the data before the meeting. If the Strait stays clogged and crude holds near 90 into next week, that's exactly the kind of supply shock that puts a hike back on the table for a committee that's already split. Consumer sentiment prints Friday, and it'll be read entirely through an oil lens this time, not a rates lens.
I'd need to see the actual break-evens move, not just the spot price. Oil spiking for 2 weeks on a geopolitical event doesn't automatically become an inflation problem the Fed has to answer. It becomes one if it's still elevated a month from now and starts leaking into shipping costs and everything downstream of it.
Translate break-evens for anyone who just heard that and blinked.
It's the market's own forecast of future inflation, backed out of what investors are willing to pay for regular treasuries versus inflation-protected ones. Spot oil can spike on a headline in an afternoon. Break-evens moving means real money is repricing what prices look like a year or two out. That's the signal that actually matters to a rate-setting committee, not the daily crude print.
Agreed on the mechanism. I just think this week's the one where we find out whether break-evens start moving, because 2 full weeks of a war premium is right around the point where headline noise starts turning into actual expectations.
So give me the one thing each of you needs to see by Friday to feel differently about where this week goes.
Tanker count staying in single digits, plus Alphabet's CapEx guide getting sold off like TSMC's did. Both of those together, and I think we're heading into the Fed meeting genuinely nervous instead of cautiously optimistic.
The backlog number holding up Wednesday and the tanker count climbing back toward the teens. Either one alone helps my case. Both together, and I think this whole week gets remembered as the one where the market overreacted twice in a row and then recovered.
For me, it's simpler. Does Stripe come back with a real number? Or does PayPal's board just say no and mean it? That tells you whether the fintech M&A wave that's been simmering all year actually has legs, or whether boards are getting more disciplined about defending fair value instead of taking the first premium on the table.
30 seconds because Sunday mornings deserve one non-market thing. I spent yesterday afternoon trying to assemble a bookshelf with the wrong size screws for 4 hours before I noticed the second bag taped to the inside of the box.
4 hours.
4 hours.
That might be a worse process failure than anything Marcus did on SOXX this week.
Hey now, I resent that on a technicality and agree with it in spirit.
Glad I walked into a show with this much self-awareness already built in.
Back to the actual point of the show, closing calls. But remember, these are for the week. Checkable Friday, not tomorrow. Eleanor, you first.
If daily tanker transits through the Strait stay in single digits through Friday, Brent closes the week above $90. That's my call, and it's the same test we just laid out live.
Marcus.
If Alphabet raises CapEx guidance again Wednesday and the stock still closes the week higher than Friday's print, that's the market voting the spending's earning its keep. That's my call, and I'd rather bet on the bigger, harder question than another single session on SOXX.
Smart, given how the last two of those went for you.
Learning happens eventually.
Dave, your first call as a member of this scoreboard.
PayPal's board doesn't accept Stripe's offer as is, and there's no amended bid above $65 a share by Friday. Deal stays unresolved into the following week.
3 real checkable calls, and we'll grade every one of them next Saturday. Here's what I'm watching personally alongside all of it. Wednesday, July 22nd, when Alphabet, Tesla, Intel, and Texas Instruments all report and the AI trade either gets its footing back or doesn't. The PayPal board meeting as soon as tomorrow, and the daily tanker count through the Strait of Hormuz, which matters more than the Brent headline print does. If the show helps you walk into the week with an actual plan instead of just headlines, follow Nova Ventures daily wherever you get your podcasts and find our written notes at novaventures.us. That's the week ahead. Good luck out there, and we'll see you tomorrow morning.